Casual, it's live.
All right.
What's up, Bigger Pockets? Welcome to this week's edition of the Q&A for the Tribe of Multifamily Mentors. My name is Chris Lopez. I'm one of the hosts, and we have a special guest that flew in all the way from Los Angeles, California last night to join us in the Denver studio. He's great at raising capital. He's great at doing some extra due diligence on operators. So we're going to pick his brain. So Terrence, how are you, man?
Super well. We just got done doing some reps and pull-ups. Hunter's also jacked and tan and can do a lot of pull-ups for those of you out there wondering. We just saw it firsthand. And yeah, Hunter, welcome to the show. Super excited to have you. You're going to deliver a ton of value and drop some bombs on the audience here.
I will say that of all the speaking engagements I've ever done, I've never been introduced as tan. This is a very unique thing. I have a very Conor McGregor type of complexion, so this means a lot to me.
Yeah, no, it's heartfelt.
Yeah,
it's very sincere. Okay, so let's jump right into it. We got a lot of people coming in. You know, one of the first questions that came in from the audience, and they've been watching you speak, and some of the things you've done recently is you raised $8.7 million in 17 days over the last, month. That's an insane number. So talk a little bit about how that came about and that whole process of raising that much money in that short of time.
So it came about through a lot of hard work. I think a lot of people, when they think about raising money, they think about kind of not taking no for an answer or even putting an excellent deal in front of some people with the money. And anybody that's tried that, it's very difficult to do. People don't see the deal the way that you see it. They haven't uncovered its uniqueness the way that you have. And they're mostly the time not real estate investors. And so, the last decade, what I've done is build an infrastructure to attract endless amounts, thousands, tens of thousands, hundreds of thousands of leads to our website, and then eventually convert them into raving fans and people that are willing to send $100,000, $300,000 checks. And the way that we're able to do that is basically get ahead of all the potential questions that investors may be asking and provide a automated, replicatable resource to answer all those questions. So, that $8.7 million, I think we had a total of somewhere around 10 phone calls. And, one individual invested $620,000. He just invested again in the same fund, another $620,000. And this is someone that I've never talked to before. And it's not because he's not competent. It's because of all the work we put in to ensuring that the relationship is nurtured. It's just not done on a one-on-one basis.
You've done it at scale through online. It's impressive.
Exactly.
So $1.2 million from one individual, and you never talked to them on the phone?
That's right.
Wow. I've never heard of that.
What
That's
was
really
your
impressive.
average capital raise per investor on this deal?
About $125,000.
Wow.
And, some groups have much larger sizes than that, but we cater to an investor base that is very focused on diversification and is looking and comparing different operators. Many of them are diversified across other, just not even multifamily, other even verticals, even non-real estate stuff. So we recognize that, but we go into the relationship understanding that we need to put ourselves in peak credible positions. Basically, everything we do needs to imply we've done this a million times, and this is going to be the millionth and one. So the risk of implementing the business plan is not on the table. And people feel comfortable because of what we do to do that. And it's real, but we just want to make sure it's communicated effectively.
Wow. That's incredible. And we're going to have the full-length interview coming up here later. It's going to release sometime in mid-May on the Bigger Pockets YouTube channel. And so we're going to go into detail, do some of the nuances that's really brought you to that stage. But that's really good perspective and incredible insight from your experience. So you just raised $8.7 million, and I've heard your story several times, and it's you have a great story of how you failed epically trying to raise money the first time.
Yeah.
And I think that's a great kind of balance for the audience to hear, because a lot of the people in the audience are trying to maybe raise money for their first deal. Maybe it's a duplex, a fourplex, or maybe their first syndication. And I think you sharing that story is going to be really relevant and really help maybe motivate and shed some light on where you started and how far you've come.
So yeah, the story you're referring to, it still kind of makes me cringe. I've told it quite a bit of time, but each time it's just helps me kind of relive that moment. Basically, I fell for the big myth of the real estate sector, which is that if you have a good enough deal, the money shows up. I'm sure everyone listening to this has heard that before. And if you've listened to it enough, you've fallen for that myth. And what happens when that happens is you yourself have come to these realizations that real estate's awesome, that you need to take money out of your financial planner's control, put it into these single family assets, multifamily assets, self-storage assets, whatever the case may be. But you just go to someone who hasn't had that realization and try to put a 15% IRR in front of them and say, don't you want this? You're trying to convince them, you're trying to unwind decades of propaganda and a short little meeting.
Right.
And it's not possible. And so, but I tried to do the same thing. The reason I know this is because I failed epically doing it. And so basically the first deal that I had done with other people's capital, I had started to develop a track record for myself, pulled a bunch of investors together in a room and gave them a free lunch if they showed up, only for accredited investors only. And 30 people showed up and there was only space for 20 people. So going into this meeting, I was just,
you're jacked.
Oh
yeah,
my
you think you're about
gosh.
to close a bunch of,
great.
There's $30 million in the room.
Yeah. 30 million.
I'm confident I'm going to raise my first million,
right.
you know, and I had made an agreement with the strategic partner that I needed to raise my first $500,000 or it was not going to work. And so, you know, there's no room for people to sit. It's standing room only in my first presentation, like all the advantages in the world. I'm texting this woman who's now my wife, but at the time was just my friend, meaning that I was just chasing around trying to impress her with how much money I could raise. And I text her like, I can't wait to celebrate this with you. Like, this is going to be a home run.
Wow.
And
you text her that.
Oh, I'm just like, watch.
Wow.
You know what I mean? Like, watch me. And we're going to be off to the races.
Right.
And then later down the road, maybe we'll get married and I'll be able to have kids with you kind of situation. Wink, wink. And so I go and give this presentation, and it's a good presentation. I'd give it today on the mobile home park business, which at the time was trading at 10 caps, meaning that we could have bought the properties in cash, done nothing, and it produced a 10% return, which is better than pretty much anyone in that room is getting. So it's a total no-brainer. And I give this presentation, and I gave people a piece of paper so that they didn't have to write down the number and everyone could see or raise their hand and say, you know, I want to invest 100 grand with you. That's kind of private. So my intention was they're going to write down the number, fold up the piece of paper, and pass it in to me. And they did that. Say goodbye. They get their free lunch. And then I go up to my room. I undo all the papers, and the grand total was zero. No one had written anything.
No comments, no feedback, nothing?
No, email me later. I'm interested, but I need to know more. Just like, I'm just not
blank
interested.
Pieces of paper?
And these are people that I had some sort of familial relationship with, right? Like, they knew me through my family, through my mom, some kind of relationship, like go to the country club, find a people, like this kind of situation, you know, word of mouth. And I bombed. And the reason this is important is that I had all these advantages. I could put 30 million in a room. I can communicate effectively. I have a background in being able to do such a thing. You know what I mean? Like, communicate complicated ideas in a way that people can grasp. All of that gave me nothing. And so I realized this is a different game. This isn't trying to get someone to buy $100 piece of knives or something like this. This is give me your $250,000.
Yeah.
And
so I'm going to cut you off here, Hunter.
Yeah,
I'm going to more your story here at the end, because I mean, I know that is like soul crushing when that happens. But guys, we're going to jump in Q&A here with Hunter Thompson. He's the author of Raising Capital for Real Estate. This book is phenomenal. So we're going to talk about raising capital and systems in place for us, Hunter. We'll go into more details on our full-length podcast in a little bit, but there's some great questions here. I'm going to start firing at you, Hunter. So Dennis O'Brien says, my challenge is not raising the money. It is setting up the logistics on the back end. What would be your first priority to set that up for success?
So in terms of property management, or in terms of kind of the implementation of the raising, you know what I mean? So
I believe the implementation of raising money is how I read that question.
Yeah.
So like, hey, he's got, investors reaching out. How do you organize all that? Is the way I interpret that. But Dennis, clarify that. But I go with that answer, or go with that question.
So, I mean, first of all, technology is a major opportunity in this space right now. And as crazy as that sounds, we're all familiar with that. Whatever technology is taking over the world, the finance sector has been very slow to adopt these things. So just now, investor portals, for example, are starting to come into line with market dynamics, where for $6,000 or $7,000, you can get a 12-month subscription to something that will make your capital raising process much more automated. So one that I'm a big fan of is Investor Deal Room. They've got a system for tracking capital raising, and it'll really help take your investors to the next rational step of their investment process.
And this is, I'm not familiar with the software systems. Like, what's the subscription fee for that? What's the ballpark?
If you have, let's say, 25 investors, maybe you're talking about $7,000 a year or something like that.
Okay.
But like in per deal. And what ends up happening is, you ever try to raise money it's herding cats. People say, I'm going to give you 100 grand. And then you have to turn into a creditor and go, now, what about now? Can you sign the documents? Can you give me the wire instructions? These types of things. This automates it so that they have to take the next rational step or they will not be included in the deal.
And I love it. I want to kind of go down a rabbit hole that we talked about lunch earlier. Because in your book, you talked about you using MailChimp, I think, which is a very popular and it's a great starter email platform.
Right.
But you've since outgrown that. And I think an important thing for technology is as you start building out your infrastructure, always think 2 or 3, 4 steps ahead. And I know you use a different system now. It's actually the same CRM that I use as well. So when someone's starting up their system, how would you recommend they view that? And like, what's your stack right now for technology on what you recommend for someone?
So just take a breath, because if this is not the tool you're using right now, I'm sorry, it's hard to implement a new technology, but trust me, it's worth it. ActiveCampaign is the industry leader for a reason. So if you're using something that's not as robust, it's going to take some time to get accustomed to using something that's like happening at the elite level, but it will be worth it. Even if you're in the process of raising your first $1 million, using a tool that is the same as institutions are using is worth the change. And I know your time is valuable, but take it from me, it's worth it.
And I will second ActiveCampaign, because when I started my business out here like 4 years ago, I spent 2 months researching every system out there, and ActiveCampaign was at the top.
Yep.
My first years, it was just basically MailChimp to me, but I really could grow into it, because once you switch CRMs, it's like getting a divorce.
That's right.
So scale from the beginning. All right. Hunter, Victor Lopez says, question on structure when you raise the commitments. Are you, as the operator, getting ownership in the fund? If so, what percent, or what are you just making for yourself through management fees?
Yeah, good question. This can vary. Before kind of giving some specific answers, I think the template for any question like this is you have to have a spectrum of what's out there and just try to do the middle, because I'm in the business of answering questions prior to them getting asked. That's how we were able to raise that money that we're talking about earlier. So you just want to have a good understanding of what the market dynamics is and just simply do that, so people won't cause it as a red flag. As far as kind of capital placement fees, if you're going to bring on, let's say, a partner who's going to raise 100% of the capital for all of your deals, I would anticipate that partner to receive somewhere in the range of 30% of all of the proceeds of the GP if they're bringing 100% of the capital. And that's a good model to use.
And if we can go into this on our full-length interview later today, I know you did some very early on research for putting together, I think, some unique deal structuring.
Yeah,
we can go into details of that on the podcast more at length, right?
Absolutely.
Because I think it's a great way you structured it, and it's becoming more popular now. But you were one of the early innovators or adopters of doing the structure of how you set it up.
Yeah, I'll just say the name real quick. It's the fund of funds model, and it's very common in the hedge fund space. Because if someone has a $10 billion minimum, for example, that's going to be hard to accomplish. So people create funds of funds, cumulatively have 10 billion, and they can cumulatively invest in that. And we're just applying it to the real estate model.
I think Hunter just said something that is a golden nugget. People need to get out their Gucci bags and really pick this one up. This is one you're going to want to keep in the business, raising capital. You're in the business of answering questions before they're asked. I mean, that is so good. It's very simple and fundamental, but like being able to think, have someone that's like invested in other people's deals and other businesses, won and lost. You've had a really good track record of investing in I think 35 syndications we talked about since 2011. And, thinking of putting, empathy, putting yourself in the person's seat that you're talking to and being able to check the boxes before they even ask them, I think is huge. And I don't think I've ever heard anyone say it that clearly, but that is so huge. If they like have 2 questions and you are able to answer those before they even have to ask them, in their mind subconsciously, I think they kind of like just the guard comes down and they're like, oh, they answered my 2 questions. Like I can now listen without being skeptical.
Totally.
Right. I mean, just being able to do that. And I think that gets, the fundamental application for the audience is being prepared.
Yeah.
The more prepared you are for whatever asset class you're in, and that comes through reps, that comes through practice, comes through having mentors, the name of the show is, the more prepared you are, the more due diligence you've done on whatever you're talking about to raise the money, whether it's a single family, a duplex, a fourplex, or a 400 unit, or ATM machines, whatever it happens to be.
Totally.
being able to check those mental boxes before they ask, I think is like, that really resonates with me. I think that's huge. Because in my mind, I think my guard comes down when someone can like answer the questions that I have before I even have to ask them.
Can I make a comment about that?
Oh, dude, please. This is all about you.
Yeah. So what you're talking about is really powerful. And there's even another layer that's even more powerful. So like, as an example, a lot of people want to hide from the weaknesses of the deal or the proposed weaknesses of the deal. And so as an example, let's say you're looking at a senior living deal right now, right? So the big risk with senior living is COVID. It's a very unique risk. It's very timely. So rather than just never mention COVID in our operating agreement or my marketing documents, we're going to do a podcast called "Did COVID Kill the Senior Living Business?"
Right.
That's the name of the podcast.
Just take it on front. Take that weakness and just nail it.
Yes. And then what they can do is super powerful, going back to this concept of kind of uncovering things. If they can uncover for themselves, damn, this is like, I'm the only one that may be in on this.
Yeah.
Everyone likes to feel like that. And so we want to give them the opportunity to uncover it. We don't just want to hit them with it. No, you're an idiot for thinking COVID did it. No, they need to be like, wow, this is actually, there's something to this. Now I want to share this with my friends kind of situation. That makes it go on itself.
Yeah, like they're buying it. They're making that choice.
They're buying in.
So they're buying it. That's right. Yeah. No, I love that. I think that's huge and something that everyone should think about. What are the concerns that the audience or whoever I'm talking to is thinking, and let me address those and hit it, front on. That's awesome. All right. We have a ton of questions here. Chris, what are we going to go with next?
Well, here's one that came in. I'm trying to multitask here. So what's the right balance of details and info to put in the deal memo?
Ooh, who asked that?
This came off of Instagram, so I don't know.
Okay, well, our boy on Instagram or girl, that was a great question because we want to cater to very savvy investors because it's going to increase your average investment amount. But a lot of passive investors don't want to read through all these mountains and mountains of documents. So a really good kind of rule of thumb is if you can take complicated concepts and communicate them through graphic design, you can get the best of both worlds. People that are skimming can see a graphic representation of something that's really complicated. Let's say like, here's the world of here's the imbalance of supply and demand of multifamily assets. Here's the demand, here's the supply, you do the math, right? So like, that's a complicated concept. If someone wants to really get into details, they can read the paragraphs under that, but someone that's skimming can go, they definitely know what they're doing. Here's the funds.
So I'm hearing you say, I've got to make it look good, but also have it cater to almost two types of people: the skimmer, but then have the details for people that are the engineers, the analyticals type range. So got to cater to those two types of personalities.
100%. The extra element of that is that we assume that everyone cares about the things we say, which is not true. We don't have anyone's attention most of the time. So what I need to do is grab your attention. And then if I can get your attention for just a minute, maybe you can read the first sentence of a paragraph I wrote. And then maybe I can convert you into a reader. A skimmer can turn into a reader, and a reader can turn into a $250,000 investor. So we cannot think that we're the star of the show. They are the star of the show. We got to get their attention, just a little bit of that shining star, and then eventually they'll, sign the documents.
And how do you? I want to, because it's very hard. Not hard, but it's definitely a skill. When you are going through and taking the written word to help, communicate an idea, how do you get good and know what that right balance is of like, hey, this is the skimmer high level stuff. Here's the detail stuff, because, at the end of the day, it is communication. It's sales. It's all communication. How can someone get good at that to make sure that, hey, they're putting the right information? Like, how can they develop that, make sure the deal memo actually connects with, it gets passed around my deal memo and it sits in Terrence's inbox.
Yeah.
How can I make it like grab to him, or how do you even go about that?
Man, that's a good question. I would say that, looking at things, everyone's looking at the same kind of things. Everyone's documents at a certain point look very much similar. So trying to look at the same data through a different lens, or try to read between the lines in such a way that you're thinking or saying something that other people aren't saying. So as an example, anytime there's a value add component to a multifamily deal, people are going to talk about how to juice the returns. Well, that same value add component would likely protect investor capital equally. You know what I mean? So if I'm coming at it as a more conservative approach, and that's my brand, I want to cater to conservative investors, rather than say, we're going to value add this opportunity to the moon. I want to say, we're going to turn on all these additional revenue streams. And then if we have cap rate expansion, we're going to be very well protected because the additional NOI is protecting investor capital. So that's an interesting kind of approach to that. just looking at things from a different side.
When you're writing a deal memo, and again, take it. I know what your team is like, but back in the early days, how long and how many revisions did you go through on one to make it? Because if it looks good, there's a lot of work behind the scenes, is my experience.
Well, if you're putting your first deal together, the way that you communicate it and the graphic design and the amount of how compelling it is, it's going to be the worst, and it's going to take the longest and can even cost the most. So like this only comes with repetition. But going back to one of the first things I said, you have to have a spectrum of what's out there so that you can kind of act within market dynamics. And the world of crowdfunding has opened this up. You can go to any of these realtymogul.com Fundrise websites and download 50 operating documents and just do what's aligned with market dynamics and try to take an interesting approach so that you can kind of catch people's attention.
I love it. That is such a simple but overlooked tip.
Yeah.
Like, go out there. It's the internet. You can Google enough stuff and
That's
find
right.
find enough examples. And then I think one of the words I've heard you say in your book, your podcast, is you're very big on modeling. Just model what all these successful people are doing, because they're doing it for a reason.
100%.
I think one important thing too, and Hunter, I'd love to get your take on this, is when you're starting out and someone's trying to raise their money for their first deal, regardless of the size, it could be 10,000, 100,000, or $1 million. The market's going to dictate what the terms are going to be. You may think that an 8% pref and a 20% promote is fair, and ultimately the investors that you're talking to are going to tell you, hey, that doesn't really make sense for me based on XYZ. Maybe it's the market, maybe it's your experience, maybe it's the deal, who knows. They could, they're going to come back and tell you the terms that they're comfortable with. And to get your first deal done, you just have to be willing to roll with that. I mean, I think you have to be flexible. Again, you have to have empathy. You have to put yourself in their situation. And, starting out, you just have to figure out what it's going to take to do it. And then naturally, when you're in your position and you're raising tens of millions of dollars, now you can dictate terms because you have the pipeline and the infrastructure, and you've turned all those, skim readers into readers to investors.
Yeah.
You've been through that pipeline and through that process. But starting out, I think it's important for, anyone to understand that you just have to be flexible and really be flexible with, they may tell you something totally different than what you're thinking.
Yeah. Yeah. So a couple of things there. So some people, this model what work principle is, I'm a big proponent of it, but sometimes, especially when it comes to experience, if you're raising your first million and you're trying to use a structure which is applicable to some institutional quality partner, you're going to have some challenges. Like if they have an 8 pref with a 50-50 split and you're trying to apply that to your deal and you're just like, look at the comps, it's going to create some problems. So be aligned with market dynamics based on your experience level. Mm-hmm. Having said that, this is huge. Price is never the answer. Terms are never the answer. It's that you haven't built up this robust infrastructure of being endless leads coming and learning and being really nurtured, and you've got these great partnerships that you're sharing with them. And so if you can accomplish a lot think about it like this. Goldman Sachs, for example, these private equity guys that take 20% carry on real estate deals, they aren't real estate operators. They just have a great branding exercise. So like the terms aren't dictating that. It's just they're establishing credibility. So there's certainly truth to what you're saying. You want to be aligned with market dynamics based on your experience, but then don't go in thinking that you're not worth it. You know what I mean? You just have to ensure that they know it too.
Right. Yeah. Because like you said, the more volume you have, you get to pick basically who you want in. And at that point, you can name your terms, right? Once you have that pipeline, like Goldman Sachs has, they get to pick.
That's right.
What the net worth is and what the family last name is and who they want, in their ecosystem.
And take a premium on the fees.
That's right.
All right. So I'm excited to hear your answer on 2 more questions, Hunter. So Alan says, I'm looking for a mentor in the Fresno, California area. And I'm going to add the question on there because this is, there's a bunch of people in Alan's situation. Mentors have all played huge roles in our careers. You talk about this on your podcast and book, Hunter. And everyone wants a mentor, and a lot of people go about the wrong way. How should Alan and other people out there go out there and seek a mentor that can really add value to them and vice versa?
Yeah. So this is the big question right now because we have access to all these great podcasts. What you guys are building is incredible. There's so many competitors out there. And so there's so much noise, right? It's like, how are we going to cut through the noise? And even within that, there's all these guests. Like you may be listening to me right now and think, I don't know what I'm talking about because I don't resonate with you or whatever, but maybe some previous guests you loved and it's, oh my gosh. So like what I would do is try not to be a lukewarm version of all of these guests that you hear. You want to be you want to be dialed into exactly where you want to go, and you want to figure out exactly who's done it. And the closer you can find someone that's doing exactly what you want to do in 5 or 10 or 50 years, and then model their moves, the easier it's going to be. Because if you try to model everyone at the same time, it's not going to give you results. I have a podcast. We've done 300 episodes. I've talked to people that have done hotels, self-storage, multifamily, ATMs, etc. And it's not the strategies. You want to figure out who the personalities are that you want to model and spend the rest of your life with. So once you do that, by the way, reach out to them. Actually, I should say, devour all of their free content. And when you do that, you're going to pick up on some nuances about their personality that only people that have listened to 100 episodes can figure a couple of things out about me. When you reach out to me and you say, I found this out about you, this out about you, and this out about you, and we have these things in common, how can I not give you 15 minutes of my time to give you a little bit of guidance that may help you save 6 months of your time? So that's what I would suggest you do. But don't reach out to them until you've just devoured the free content. So when they do, they see a mirror in that email. You get the email, they go, damn, how can I not help this person?
And I want to really emphasize
really
that point because, yeah, you're right. If people don't like spend time on Google or LinkedIn or Bigger Pockets researching you, it's like, dude, I've talked about like 18 times my podcast. Like, if you listen to like 2 podcasts, I've already been a broken record to you on that. Like, come on. But you're right. When people do their due diligence homework, oh, yeah, let me help you out.
I'll do whatever I can to make time. My schedule is ridiculous, but there's a couple little things where it's like, man, I got to just give them a little boop, boop in this direction because it'll save them the time.
And we've all had those people, they give in to us
Yes.
and we want to pay it for, like, hey, this guy or gal helped me along the way. And you kind of have that, want to pay it back. All right, we got time for one more question here. And I think this is going to be right up your alley, Hunter. From Dennis O'Brien again on Facebook.
A repeat guest here.
Yeah.
Same episode. I like it, Dennis.
What is the expected average return a private investor is looking for? Second question, if your portfolio is a mix of short-term and long-term assets, what do you set expectations on dividends and investor payouts? So that is a onion right there.
Yeah.
So I'll let you start peeling that back.
I mean, like I was kind of saying about price never being the answer, I try to communicate that when we talk to investors as well. And I try to just make it not consequential. Like basically what I say is we're not going to be interested in a deal unless it can produce low to mid-teens. And that's all I say.
For IRR, right?
For IRR. That's right. And the reason is everyone's underwriting to the same thing and people are going to squeeze the numbers to make a 15% deal look like an 18% deal or vice versa. But it's not really consequential. I want to turn it back on Dennis and figure out, are you the right investor for us to bring on? Because this is our vision. Are you buying into this vision? Here's our investment thesis. Is this aligned with your dynamics? And we can have a more mutual conversation. And this is not an act, right? It's at first when you get started, it feels like an act because you're like, if you're raising your first 25,000 and this person's potentially going to invest 25,000, it is 100% of your business. Your whole business is on the line. So what you feel like is that it's a super needy situation. And someone who I quote all the time in my book, Orrin Claff, that's the number one killer of deals is neediness. So those are the return profiles, but that's not the point. You can go Google around. You're going to find people that are talking about 15% returns or 30% returns. Here's our investment thesis. Here's our background. Here's our view on risk-adjusted investments. And is that similar to your view? If so, here's a bunch of resources you can check out and the deals that we have that are kind of aligned with that.
Drop some knowledge on the audience about risk-adjusted returns, because I love the way you explain that and kind of your view of that term, because that gets thrown around a lot, especially in this kind of climate. But yeah, share with the audience what that actually means and your kind of spin on that.
Yeah. So it's like, basically as investors, we want to find ways to get disproportionately favorable returns for our investments. So again, as an example, if you're incurring a 4 out of 10 on the risk spectrum, you want to incur like a 9 out of 10 on the return spectrum or something like that. It's disproportionate, right? It wasn't a 4 and a 4. That would be proportionate.
So the more risk you're taking, you want higher upside.
Yes,
right?
But I'd like to limit the risk as much as
right.
possible and still keep the returns favorable. So as an example, like just a rule of thumb type of thing, we've never invested in development. And I have been told by developers that this isn't an accurate way of looking at it, but just provides like some context. My view is that development is usually like twice the amount of risk as a typical value add deal, but the return profile is not twice. So assuming that's a correct, for example, for just a moment, we would never do that deal because it's not proportionate. It's disproportionately not favorable. So that's what risk adjusted is about. Can I say one thing about kind of a strategy?
Please keep going. I think you're in your sweet spot right now.
Okay.
Yeah.
So one, like in terms of risk adjusted, I want to be as not market dependent as possible. So things like cap rates, especially exit caps, for example, that are way down the road, which are going to play a huge role in the return profile, but are totally out of my hands. I want to stay away from that risk as much as possible. But something like expense reduction, that is certainly within my hands. And so when I'm thinking about things on a risk adjusted basis, if I have a property in Houston that is producing, let's say, a 48% expense ratio, and we're about to buy an asset that's producing a 65% expense ratio, meaning that 65% of the owner's income is going to pay off expenses. All we got to do is buy the asset, move the same team that's right down the street to this new property, reduce expenses proportionally, same size, same vintage, etc. That's a very favorable risk-adjusted type of situation, and it's not dependent on the market dynamics. So just one example.
That's
phenomenal.
great.
Yeah.
And Bigger Pockets, we're going to have to wrap up this Q&A. We're at the actually past the 30-minute mark. We are talking with Hunter Thompson here, who is the author of Raising Capital for Real Estate and also 300 plus episodes on the Cash Flow Connections for Real Estate podcast. So we're going to hop off here. We're going to take a quick break and record a in-depth interview with Hunter and actually talk about a story, but a couple unique things. We're going to talk about his poker playing days, how it helped to raise seed money and help him figure out the risk-adjusted basis on how he analyzes deals now, which is really interesting. We got some insight at lunch earlier today. And we're going to dive into a 246 unit. Am I close enough there? 247 unit in Albuquerque, New Mexico. Right. And actually go through a deep underwriting about how he underwrote it and how he raised capital for it. So stay tuned for that coming out in the next May-ish, June timeframe. So Hunter, real quickly, what's the best place for people to find out about you, reach out about all your educational content and more about what you do?
So this book is available for free plus shipping at raisingcapitalforrealestate.com, and they can go check it out. It's like $8 for the shipping, and it's like my life's work. So enjoy.
And I can tell you, this is a great book. Grab a copy.
Disproportionate value right there.
Exactly.
$8 for all that value.
And you'll see why he gets investors logging onto his portal and writing checks that we're talking to him on the phone.
That's right.
Because the secret sauce is in here. Hunter, thank you so much.
Appreciate it.